Okay, welcome everyone to this event, this month's or bi-weekly masterclass group coaching call. This is live. It is being recorded, and all of them are always placed up on the membership archive sites. There's so much up there now. There's so much incredible content that you can go back there. I'm going to start actually have somebody start to put in some descriptive paragraphs next to each recording so you know exactly what's going to be talked about on that particular group coaching call, because every group coaching call we try to do is have some type of a topic. Now, this has just kind of come about. It was never intended to be a teaching call. It was meant to be more of a coaching call where students could come online and get live interactive coaching from me. In this particular case, what's gone on is, I decided to start teaching. And then if anyone had any questions about any aspect of the business that they were working on, if they had any properties that they were looking at that they needed help with, then they would just ask questions. And you can ask questions either in the question box, or if you would like, you can raise your hand and I can take you off mute and you can speak to me directly. That's always an available way that we talk to our students. Now, there are a lot of new people on the call. There are a lot of new coaching students. This program has really taken off. I just got to tell you guys, I love this group masterclass program. It is exactly what I wanted to do. I think it is the best value on the market today. I love helping as many people as I possibly can buy properties the right way, which is the key here. And I've been getting some really nice, very nice feedback on the quality of the content and the and how I present certain things. So, as with every masterclass, let me give you the disclaimer. I am an attorney, but I am not your attorney. Always hire competent counsel in your jurisdiction to help you through any transaction. And let me just give you guys a little bit of an aside here and why I always say that. When I was, if you go back on my website, you can see my whole story with the SEC. You can just shake your head and you can't believe that that's our government out there. And it really, that's, changed my perspective, my wife's perspective on our government. But during that time, one of the actual benefits was the fact that I'm an attorney. So I was held to a different standard. And so when the whole SEC thing was done, I then got called before the Bar Council of the Commonwealth of Massachusetts Board of Bar Overseers. And that was essentially the first objective, quasi-judicial administrative board that looked at the facts of the case. And came back with their ruling, and they, I could have lost my license. That was what we were all living in fear of. And they came back and said I did nothing wrong. With one caveat, they said that I should have disclosed better to everyone that I was not their attorney. And, I thought I had done that. And, one attorney that I had spoken to and shown the letter, both said, hey, they had to find something wrong. So that's what they came back with. But nevertheless, now, whenever I am speaking to somebody or in a crowd, I always very, very clearly state that I am an attorney, but I am not your attorney. My advice is not meant to be legal advice for you. Everyone's situation is different. You really need to sit down with an attorney who knows what's going on in that particular area to help you out. I mean, the way I typically sell my services is not as legal services, but more as consulting services. I can consult to you. I cannot provide you with legal advice, even though I will always conduct myself in a manner that's commensurate with or indicative of the ethical canons of the bar. So, all right, there's my little disclaimer. Kind of went on a little bit more because it's kind of a slow news day. But I wanted to talk to you today. As you know, there is, and if anybody can hear anything in the background, they are testing the loudspeakers for the nuclear power plant that's about 10 miles down the road from my house. So you might hear some feedback, and if you do, I apologize. It may last a minute, but that's the benefits to living near 3 Mile Island. I'm just kidding. I don't live near 3 Mile Island. Okay, so if anyone has any questions, type them into the box. If you have any questions about any properties that you're working on right now, go ahead and put it in there or raise your hand. Let me know if it's something that you want to talk about in front of the crowd, because once you start speaking to people in front of the crowd, there is no confidentiality, so just understand that as we go through it. Now, the topic for today's discussion is going to be crowdfunding. I don't want to have okay, hopefully that was it. I don't want to have a textbook lesson here on crowdfunding, like what is crowdfunding, what's the Wikipedia definition, and what are people doing, what's the SEC rules, and what's the history behind crowdfunding. Go on the internet, you can find all that stuff out and learn. What I want to teach you today is really the nitty-gritty, the nuts and bolts of crowdfunding. And I'm going to actually use a real-life scenario of a property that we've been working with to try to get crowdfunding. And I'm going to show you exactly how it works, and I'm going to show you the good, the bad, and the ugly, because I want you to understand, if people look at this crowdfunding concept as the panacea that it could potentially be, you've also got to understand the drawbacks that it is and understand how to work around those types of drawbacks. So having said that, let's move on. What I want to show you here are a couple of websites that I have a little bit of experience with to give you an idea as to how this works. This particular website, there may actually be an interview in the resources and archives section of the membership site where I interviewed Jillian, and I cannot remember Jillian's last name, from Realty Mogul, and she talked to us about how crowdfunding works and how their crowdfunding works. And it's very interesting that she said certain things on the call that if you understood the terminology, you would realize that this particular crowdfunding site is not really the right place for many new investors to be looking for. This particular website, and a lot of crowdfunding, are looking for experienced investors who are looking to put their own money into a deal. Those types of things. That's what we're seeing right now with some of the different crowdfunding sites that are out there. So I recommend you go check out realtymogul.com. Sign up for their education center to get some really good stuff in here. That's why I said, listen, I'm not going to get into an educational discussion about crowdfunding, because you can go in these places and you can find out all you need to know about crowdfunding. Okay, so make sure you do that. What you also want to do here is, or actually it's more on the join now. Go ahead and sign up, join these groups, and that way you'll be able to see what type of offerings they have. And that's very important because you want to know what each different crowdfunding site will look for in a particular deal. Different deals, different crowdfunding sites invest in different types of deals. Not all of them are going to be multifamily. Some of them are strictly triple net leases. Those are the types of things that you need to know where to go to find the right type of crowdfunding site. All right, here's another one. Fundraise. Now this one is a little bit different. This one, as you can see down here, look at, they actually state 12 to 14% average returns. The top real estate companies are on Fundrise, and here are some of the names and types of properties that they're all looking for. So but this is what you see on these crowdfunding sites. So essentially, what they're doing is they're raising the private money for you, so that you can just go out there and find the deal, and then partner up with this crowdfunding site, and they will provide the capital to make the deal happen. All right, now, for those of you that just heard what I said and think that you hung the moon and that look how great this is going to be, we're just going to be able to find deals and we'll turn it over to these crowdfunding people and they will come back with with all the money we need and life will be great. It doesn't work that way. You need to stay with me here during this particular webinar, and by the end you'll see what I'm talking about, why it's not all that it's cut out to be. All right, so let's take a look at right here. This is a call, the National Crowdfunding Association. Now, the National Crowdfunding Association, it's my understanding that Scott Whaley is the guy behind this particular site, this particular association. These are like all the crowdfunding people come here. They have a conference every year. All real estate investors like you come to these seminars to try to find out exactly which one is the right one to start working with. But Scott Whaley is the president or chairman of the National Association of Real Estate Investment Clubs. Now, I, along with my buddy Duncan Weirman, we run the Boston REIA, which is a part of National. And so we fall under Scott Whaley's tutelage, so to speak, and Scott has started this crowdfunding association. It's kind of like an offshoot of the Real Estate Association. So this is coming from a guy that understands the real estate investor and knows what they're all about. So I recommend that you also check into this particular site as well and start getting used to how they operate. Now, I'm going to start to move into the nitty-gritty part of the discussion, all right? And we come up to this particular web company called Liquidity. Now, Liquidity is a crowdfunding site, predominantly in the Midwest. They are all about raising money. You see, they have their own university, just like Real Mogul had their educational arm. Okay, we have to wait for it. And then here they talk about crowdfunding 101, the core concepts. You can download all of these things. A lot of good stuff on here. Now, what I want to show you here are you can check on the investments, and you can find what investments this particular site is looking at. Now, as you can see, they only have one going on right now, and it's they're looking to raise $285,000. It's Jesse Clem looking to raise $285,000, and it's a multifamily property. You can get more of the project details right here. So here's what you need to envision. So this is where your deal is going to live, okay? And this is where people will come that you don't even know about, that are just out there. And this one got closed, so they're holding it 5 years, 9 to 11% return. Actually, this is what I wanted to show you. If I can find it anywhere, it's not showing it. Maybe who had that? No, I think it was Liquidity. It showed that it was a $5,000 per unit raise. So they were accepting people in the deal for as little as $5,000. And that's great. So what happens is Liquidity will go out there and raise the $285,000. Whoops. Love it when that happens. They will go out there and raise the $285,000 that's needed in increments as low as $5,000. Okay? Let me see if I can switch it over here. Jump on back. There we go. As low as $5,000. Now, I do not, if you were to raise the money on this project, I don't recommend raising them in $5,000 increments. The beauty of a crowdfunding site is they've got the platform to be able to manage all of those small investors. Like that would be almost 60 investors here in this deal, this little tiny deal, and you've got 60 people you've got to deal with, 60 people that you've got to write draft K1s for every February, 60 people that are going to be calling you up asking you questions. On a small property like this, that's tough to do, but that's what the crowdfunder does for you. You go out there and find the deal, you manage the deal, but then you go out and you don't have to deal with any of the investors. That's a kind of nice problem to have, okay? Now, here's the catch, and I'm all about the catches because this is not a business for get-rich-quick schemers. There's always a price to pay in all of these things. And the price to pay in this particular scenario is the fact that these crowdfunding sites come at a price. Sometimes a very high price, okay? Hold on, let me take a swig of water here, and I'll come back and tell you a couple stories. All right. So, my wife, and if you're coming to the due diligence seminar, my wife is a business consultant. She has her MBA, she's very smart, she's done a great job with a lot of companies, and she has one particular partner down in Tennessee, and they've already done a pretty big real estate deal together, and they're now putting together a startup business. And this particular partner doesn't need money. He doesn't need the money to start up this business. He's got, $1 million in his IRA. He makes $800,000 a year. He has a 9,000, point credit score, if you know what I mean. The guy just doesn't need capital. And he can start this company without borrowing a dime. But for some reason, he's totally enamored with venture capitalists. And he thinks the only way he's going to be able to make this company go national is if he sells his soul to a venture capitalist. So they've been having meetings with VC funds. And my wife comes out of those meetings shaking her head. And her partners comes to her like, what'd you think of that? What'd you think of that? She says, I think that guy is out of his mind, what he's asking for. And here's what I mean. Venture capitalists are also known as vulture capitalists. They will come in there and take every piece of meat off the bone they can. In this particular case, one guy was offering 49%. He talked his partners down from 51. So he was going to let my wife and her partner retain 51% of this new entity. And they were going to value it at $10 million. And the valuation is far greater than $10 million. So these guys are going to steal 49% of the deal for essentially $7 million. They were going to require this rich guy to put up about $3.5 million of collateral just to secure the $7 million. So it wasn't even a $7 million loan. It was really just the use of his own money that he's going to have to pay back over time. So it was a ridiculous offer. And then the guy wanted to come on board as the CFO of the company for $300,000 a year. And the guy walked out and was like, well, that's kind of an interesting proposal. My wife's like, are you kidding me? That guy just robbed you blind, and you're still smiling about it. And so that's what venture capitalists on the business side are like. Now, on the crowdfunding side for real estate, I'm seeing a lot of similarities between the venture capitalists for the businesses and the crowdfunders for the real estate. All right? Let me give you an example of exactly what I'm talking about. Now, we've been working with this particular company, Liquidity, for a little while. And very good guys, very knowledgeable. They know what they're doing. They're a startup company. They're trying to get things going, and we're trying to work with them. And we have this small deal. And the owner of this deal is a friend of ours, and he's working with us, and we're trying to put the whole package together. And it's a nice, little 36-unit apartment complex down in Charlotte, North Carolina. So, here we are deciding that maybe we can take this deal to a crowdfunder and put the whole package together. Now, Duncan and I have been working on this one because these guys came to us through the national RIA, and they want to get something over with national, and we're trying to help them with national as well. So we've been going back and forth for far too long on trying to get this deal wrapped up, and I can tell you that it's been very challenging. But what I want you to see here is what a term sheet looks like, what these guys will actually offer you for your deal. All right. Now, this is what I mean by seeing the nuts and bolts and the nitty gritty. Hold on one second. I'm just going to jump on over and check to see if anyone has any questions, because I don't want to keep talking if people have questions. Oh, good. I do have questions. Hold on one second, folks. Bear with me. Wow. Questions about non-drill equity. Oh, okay. Questions about traditional non-crowdfunding equity investors. Okay, so the person who is this? Okay, Ted. Ted prefaces his question by trying to make a distinction between traditional equity investors versus non-crowdfunding equity investors. And the fact is that there's really no difference between the two. If you're a crowdfunding equity investor, you're buying into an LLC just like you would be if you didn't use a crowdfunding site. So the type of investment or the form of equity ownership is essentially the same between the crowdfunder and the traditional equity investor. The difference is that, okay, think about it this way. If you didn't use a crowdfunder and you want to raise the money yourself, you're going to keep a percentage ownership of that deal, right? Everybody understands that. The crowdfunder comes in and he wants a percentage of what you have. And the question becomes, how much do you give up? All right, so that's the issue that we're going to be looking at in a moment. All right, so let me just read these questions. We've got two questions. If a tenant files a lawsuit where the owner defaults on the loan, do the equity investors have any liability? And then the second question is, if the managing member of the owning LLC wants to sell the LLC, can the equity investors veto that sale? If the managing member wants to get a second lien of the property, can the equity investors veto that? All right, you know what? Let me go through this particular term sheet. I think one question will be answered by a review of the term sheet, and then when we're done, I'm going to come back to this question and answer all of those types of questions. But if anybody else has any questions, please type them in the box, all right? So, all right, thanks, Ted. You will have all of those questions answered, I promise you. Now, so here's what happens. We give the financials to Liquidity. Liquidity takes a look at the deal, and they say, okay, we'll come into this deal. We'll propose this deal. We'll put this deal on our website. And we'll ask our investors to pitch in $5,000, $10,000 minimum into this deal under these terms. So let's take a look at exactly what we're looking at. So they name the terms. The purchase price is $1.25 million. Okay, that is set by the purchase and sale agreement. The closing costs are estimated at $60,000. Where did that number come from? In addition to this page, I'm not going to show it to you right now. It's not because there's anything confidential. I just don't want to go into a whole other page. In another page that they sent, there is in another page that they sent, there is a sources and uses page, and that's where they break down the $60,000, and that's where they come up with their acquisition fee. Remember how all of us are trying to make a nice little acquisition fee at the closing? Well, so are these guys. And sometimes when they put their acquisition fee into the deal, there's not enough left over for you. Okay? Think about that. Now, capital improvements, $60,000. We had a discussion with them, told them what we would need to really bring the property up so we can start getting higher rents. We said we need to upgrade the HVAC. We have a quote on it for $60,000. They want to make sure the $60,000 is in the raise so that we can get that done and bring up the value of the property. Very, very smart decision. I like it. I think that's the way it should go. Now, funded reserves, 5,000. That's just something right straight from the bank. The bank is the one that's going to be coming up with that requirement. We want to make sure that it's put in there ahead of time. That is the bank's requirement. It's not the LLC's requirement. Okay, hold on, guys. One more swig of water. And I guarantee you it is water. A couple of wise guys out there. All right. Now, check this out. This is really interesting. And this is something you need to take into consideration. These guys are showing a 30% down. Okay? I have a letter of interest from my mortgage company showing that they can do this deal with 20% down. All right? Unfortunately, here's the problem. And this goes to one of Ted's questions, is if we go below $1 million valuation, we are not eligible for a small cap Fannie Mae loan. That means that the partners are going to have to sign personally for the loan. The managing partners are going to have to sign personally. They don't want to do that. So, but the thing is that this particular liquidity is saying, well, we don't like to take on risk for our investors. We like to be very conservative, so we like to put more money down. So that means we want to put 30% down. Well, when you put 30% down, the face amount of the loan comes down below $1 million. And now all of a sudden we have to sign personally. So we went from a non-recourse loan to a recourse loan so that Liquidity's investors could be safer. The managing partners have to take on more risk. Now that is fully a function of the fact that this is a small deal, a 1.25. But you've got to take that into consideration when you're figuring out whether you're going to do a crowdfunding site like this or exactly how you plan on structuring the debt on the deal. All right? So think about that when you're starting to do the raise. Now, they're going to raise 30% down the estimated closing costs and capital improvements. So they want to raise $500,000, and they're looking to do it in $10,000 increments. So they're looking to take on as many as 50 investors, but they're only dealing with accredited investors. So this is going to sail right through the SEC issues, right? Okay. Can you do this? Can you find 50 people at $10,000 a piece, all accredited, all been certified as being accredited? Man, that's a lot of work for you, isn't it? It really is. That's what makes these crowdfunding sites look really good, don't they? But you've got to think about what it is that you're giving up to get that type of convenience. It can be very pricey. Let me show you. Right. So what we come down to is now we start getting into the nitty-gritty negotiations between the crowdfunding site and us as the investor, as the people that find the deal. All right, this is where things start to get kind of sketchy. And I can tell you, just from personal experience, I'm acting as the attorney for the investor group, and so we've had some discussions with Liquidity. It's got kind of testy at times. Both sides want to make the deal happen, but both sides were kind of drawing a line in the sand, and for very good reason. So let me walk you through my perspective when I first saw this term sheet and how I would think as a managing member of different properties, as an owner-operator of different properties. This is what we came up with. So they said no preferred return. All right, so we're going to structure the deal so that all of the investors are getting the same amount. All right, managing members, check this out. The managing members are going to be Villa Court Partners, that's us, and Liquidity and or an affiliate limited members. All right, so essentially what we're saying is that 30% of the deal goes to us, and 70% goes to those people kicking in the $10,000 a piece. And out of that 30, we get to keep 25, and Liquidity keeps 5. Sounds pretty good? You might be thinking to yourself, yeah, that sounds great. That sounds great because, man, I was thinking I'm going to have to split my deal 50-50 with somebody, and here you're keeping 25% of the equity. That's not bad. Yeah, and it isn't. Let's read on. The managing members, check this out. Managing members, Liquidity and Villa Court Partners will own a managing membership interest in the company. Villa Court Partners will incur a loan secured by first mortgage on the property for $800,000 to use for a portion of the purchase price. All right, no problem. Now we start talking about the 70% people. Let's find out what their deal is going to be. Investors in the property will acquire equity memberships and thus will own an indirect equity interest in the property. The limited members will be responsible for 100% equity investment of $500,000. The minimum investment in the company is $10,000. Further, the limited members will be entitled to 100% of the profits until the original capital contributions of $500,000 is paid back. Let's think about that one for just a second. Yeah, trying to get the whoops, I kind of froze up. Does that concept sit with you? Look at the way it. Oh, I love it when it does this. All right. Let's try this again. Here we go. I think Ronnie was laughing. Yeah, Ronnie in her, I think she was using Hispanic tone. It's J-A-J-A-J-A. Ha, 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 ha. Yeah, exactly, Ronnie. Think about that, guys. Because remember, you're working on this deal. Liquidity has moved on to their next deal. You're stuck down there with the Village Court Partnership property down in North Carolina, 36-unit property. You're working your butt off, and how much are you getting paid? I'm not hearing you. How much are you getting paid? You're getting paid nothing until all the $500,000 is paid back. Do you get that? Do you like that? Neither do I. All right, so let's talk about this. The company's available cash will be distributed quarterly, all right? Let's highlight that. Will be distributed quarterly at the discretion of the managing member after the first 6 months after acquisition, okay? The limited members have priority over all company distributions, receiving 100% of the company's available cash until they have received all of their capital contributions back. Once this threshold is met, the profits of the company will be distributed 70% to the limited members and 25% to the managing members. Okay, you got to ask yourself the question, why? Why is that good for anybody? How does anybody benefit from that? You know who benefits from that? Liquidity benefits from that. How do they benefit from their investors getting all of their money back right away? Because what it does is it accelerates the velocity of the cash, and it makes the cash-on-cash return for those investors much stronger, and therefore liquidity is able to report to all of their investors on their website what great returns they are getting for their investors. You're killing yourself so that they can sell more to other deals. All right? You get it now? So that the convenience of a crowdfunding site might have just been totally lost. Now, does that mean you're not going to make any money? No. What it means is that you're not going to make your money back until you have sold this property. Essentially, you're not going to make a dime on this until you sell the property. So you're going to work all that time for nothing. Okay? You guys get it? You seeing it? Okay, let's see what else. Liquidity fees, 2% acquisition fee of the purchase price. Okay, you remember the $60,000? That's $60,000 closing costs. Remember, they put that into the raise for the $500,000. Typically, don't you want to put 3% in for yourself? Where's your 3%? It's nowhere in there. You got to add it in there, and then when they add, you got to get permission from liquidity for them to say, well, you know, when you add the 3% in there, it doesn't really become a good deal anymore. So we're not going to do the deal. Oh, whoa, whoa, whoa. Okay, fine. We'll cut back on our fee. Yeah, that's a good idea. They have you. They're like that vulture capitalist. Okay? So you need to understand these types of elements of a crowdfunding deal before you sit down with them, before you find that first deal and you need to raise the money. Start working with crowdfunding sites now, getting a feel for what they're looking for, so that when you find that deal, you can build in all the things you need to have in your deals so that you're not going to get screwed at the closing table by a vulture capitalist. Okay? They charge a $2,500 platform fee. That's for, you know, believe me, guys, they can have that. And it's also the asset management fee. If you're dealing with 50 investors on a 36-unit property, that is money well spent to get out of, you know, get that off your desk. That's going to make your Februaries a lot easier. All right, so that's not bad. The acquisition fee, though, man, these guys are taking the 2%. You're going to take 3%. They're taking 2%. Can the deal handle 5%? I don't know. It had better, because that's what they want, and that's what you want. So be very careful. All right, let's see what else we have in here. Okay. Oh, check this out. From an investor perspective, we would recommend the sponsor, that's you, contribute funds to original equity investment, 2% of the raise. From liquidity's perspective, we would most likely also contribute funds to the investment. So in other words, they want to see skin in the game from you. You thought you were going to buy this deal, no money down? Well, the crowdfunding site wants you to have some money in the deal. What do? You negotiate. You say, well, you know what, guys, we really negotiated a great deal. We negotiated a second mortgage. We negotiated this, from the seller. So that's really going to be our contribution. We've earned our keep in the tough negotiations that we did. That type of thing. You can try using that line. We did, and it worked. Okay, so everything is negotiable, and I can tell you right now, you might be looking at this thing. Well, why should we continue negotiating? Okay, so that is what a term sheet, and this is a very, very, and what's missing from this particular term sheet was discussions of the operating agreement. I really started getting into the nitty-gritty of the operating agreement because, you know what, I'll tell you, these guys are new. What experience do they have with managing a multifamily property? And I really kind of called them on it. And, because the way the managing the operating agreement was structured is that we would have to get permission from them to do certain things. And, I own and operate my own properties. I know what it takes to run a property. I'm not going to be sitting here having to track down some guy and ask him permission to change a furnace out, who's never had to do this before. So those are the types of things that you really need to hammer out when you're going through this analysis with a crowdfunding site. I'm coming in for a landing on this particular analysis. Type in your questions. I'm going to go through your questions, but let me kind of sum it up by saying this, is that, look, guys, this is just like, you're starting a business. Every business needs capital. You guys need capital. Even if this wasn't a real estate business, but it was a tech company, you'd be looking at venture capitalists and trying to raise money through them also. And that's, with a crowdfunding site, it's no different. All right? Business is business. Ours just happens to be using multifamily property to generate the revenue. So our crowdfunding site's good? Yeah, I think they are. They serve an excellent purpose. I think and my whole purpose for my discussion here today is to open up your eyes. I want you to be totally understanding of how it works with venture capital or crowdfunding when you go out to the marketplace. Start the conversations now with the crowdfunding sites. You might be able to tap into one they solve all of your problems. They're perfect. They're great. They're exactly who you want to be working with, and bravo to you. And now you can go out there and get all of your deals funded, and you're very, very happy. So that's the way you need to approach these sites. Just be very smart business people, because that's what you are. You're a business person. Okay. Wow. Let's take a look at, get some good questions already. All right. Here we go. Let's go back to Ted's original question. All right. If a tenant files a lawsuit or the owner defaults on the loan, do the equity investors have any liability? Okay. You're asking the question without giving me enough information. I'm assuming, Ted, that the property is owned within a limited liability company. And if it is, the owners do not have any liability towards a tenant filing a lawsuit. The tenant will file the lawsuit against the LLC that owns the property. The LLC is the business. The asset of the business is a property. So they will file a lawsuit against the LLC, and they cannot name any of the owners of the LLC, any of the members of the LLC, unless the LLC has been run so incredibly poorly that it is nothing more than a fake entity, and that and the reason for examples of that would be things like they don't have their own bank account, they use commingled funds, they don't have a board of directors, or not a board of directors, but a membership meeting. The operating agreement has never been followed. They've done everything. They don't even file with the state in order to keep their LLC registration current. In those scenarios, a lawyer suing on behalf of the tenant may be able to, what we say, pierce the corporate veil and get behind that LLC and go after the members directly. That's why you always want to make sure, if you're getting yourself involved in an LLC, you know who's running it, you make sure that they're doing everything correctly, because that provides you with the level of protection that you need. All right, so that's if a tenant files a lawsuit. Or if the owner defaults on the loan, do the equity investors have any liability? No, typically it depends upon how it's structured with the bank, but typically it's the key principals who are the ones signing personally on the loans. So if they default, then it's a recourse loan, the bank goes after the key principals, not after the individual equity investors. Okay, so when you are getting that loan and you sign as a key principal, you've got a whole other level of documents that you are signing over to the bank that the other members do not have to sign over. Okay. So that's number one. Now, number two is if the managing member of the owning LLC wants to sell the LLC, Can the equity investors veto that sale? It all depends upon what the operating agreement says about the duties and responsibilities of the managing member. If the managing member, as the managing member, part of his responsibility is to maximize the sale, and he does that the way he's supposed to, then he's doing the right thing. Can they veto the sale? Well, it all depends upon what the operating agreement says. That's why whenever you're doing your due diligence and you're buying the property from an LLC, you want to make sure that you have all of the managing members or the managing members. You want to make sure that they are authorized in order to make that sale. I was one time involved with we're trying to put a deal under contract in Texas, and we're dealing with one particular member. And he says, yeah, we're having kind of a membership squabble. He said, okay, well, what's a squabble? Well, one of the members is a jerk, and he's going to be a problem, but I'm one of the two that we're going to override that guy, and we'll be able to execute the contracts. Okay, all right, that's fine. One day, so we get the deal under contract, and we're looking at the deal. I get a phone call from a guy, and he says, hi, I'm John Smith. I said, hi, how are you? He says, I understand you have my property under contract. I said, sorry, I don't know who you are. Well, I'm John Smith, and I'm the managing member of that property. You signed a contract with another guy who has no rights to be able to sign that. The other partner and I are in total control, and you can do whatever you want, but that property will never be sold to you. So I spent all this time because I didn't get the right people to the table and sign. That's why if you hear of any type of an ownership dispute or any type of area where there are three decision makers, you want to make sure the letter of intent, you want to make sure the purchase and sale agreement is signed by all of those people. Well, that guy can't sign, well, then we're not proceeding forward. I want all three signatures on there. I can tell you guys, that's something they'll pull a fast one over on you. It just happened to me the other day where we're negotiating a particular transaction, and I was familiar with partners on the other side, and I knew one guy was an absolute snake. I get the first draft of the contract over, and I said, no, we're not signing this. I revise it. I send it over to them, and I have 7 signatures on the signature block. And they come back and say, no, we're not signing that. I said, fine. All right, we'll move on. I knew they had a gun to their head. And sure enough, the day before they had a gun to their head, they went and came back to me and said, okay, here's the contract back. Essentially, it's exactly the same. We just modified the dates. Go ahead and sign it, and we'll see. We'll accept your terms. And so I open up the document they sent back over that they claim was essentially the same document with just a change in the date, and I noticed that now there were only 6 signatures on the back. And that one missing signature I knew was that pain in the neck partner. And I said, wait a minute, you said this was essentially the same. Where's his signature block? Oh, you're being incorrigible. You're being tough now. We're not, you have to sign it the way it is, or we're going to cancel this deal. I said, forget it. We're not signing this deal unless that guy's signature is on there. And they refused to do it. And I knew that behind the scenes, that guy said, I'm not signing that contract. I'm not going to have any part of that. I'm not going to get involved with that. And if he didn't get involved, we were wasting our time. So that's why, you've always got to be very careful whenever you're dealing with other members and other partners. Make sure that you get that squared away. Okay, final sip of water. All right, that answers Ted's questions. So Ted, I hope that answers your questions. Then I've got Ronnie's. Okay, zero pay. What is the NOI, net operating income? I wonder, does it make sense for that time period? Okay, Steve, I'm not quite sure I understand. Sure, Ted. Steve, I'm not quite sure I understand what is the NOI. See, the problem was that when we were doing our NOI analysis, we came up with X, and when they were doing their NOI analysis, they were coming up with X minus 20,000. Now, remember, it's only a 36-unit property, so $20,000 makes a lot of difference. Especially, I mean, where's my calculator? If we're talking about $20,000 on I think it was about a 7.5 cap. You're looking at about $250,000 on a $1.25 million property. Wow, that's almost 20% valuation right there. So a difference in their NOI calculations of $20,000 is a 20% differential in the asking price. So it didn't make, we were going back and forth with them and trying to, figure out why their NOI was so much different than our NOI. So, but that's the type of thing that you're going to have. you're going to have those types of arguments back and forth with your crowdfunding site. So you want to make sure that when you approach these guys, you look very professional. You know what you're doing, and they'll appreciate your knowledge base. So make sure that when you do the analysis, you're doing it correctly. Let me just see. Oh, okay. Steve just said I answered the question already with the fact that you would have to wait to sell for the deal to make any sense. Exactly. You have to wait because think about it. That property, that $1.25 million property, will have to generate $500,000, almost 40% of its valuation, in profit, dollars below the line, in the next 5 years to pay back all of those people their $500,000 and then start paying you money. A property like that does not generate that type of cash. Typically 10 to 12% return. That's all it's going to generate. It will not generate $500,000. The only way it's going to generate $500,000 is if it's sitting on some oil shale, and you just sold off the mineral rights. Now, that's the only way you're going to get a huge check like that out of a property like this, and that's just not going to happen. So that's why I am very confident when I say you are not going to see a dime on this deal until the deal is done. All right? Okay. Yeah, and working too long until you sell. Exactly, Steve. You're working too long and too hard. And that's the problem what I see a lot of new investors making, is they don't realize that the easiest part of this business, believe it or not, is raising the capital. If you've got yourself a great deal, you'll have no trouble raising the capital. The tough part is running those properties every single day. And that's what you have to do. It's a business. If you owned an ice cream stand, you'd have to scoop ice cream every single day. Now, I'm telling you, folks, I love the multifamily business. It's the best business I've ever been involved in, but it's a business. And for someone to say that they can do it show you a way to do it that a 12-year-old boy can do it, then, good luck to him. But that's just not the way this business operates. It's a grown-up's business. So just be very wise. All right. Rob said, when evaluating property, should reserve replacements, capital expenditures be included in the NOI? If not, where is it accounted for? Because it obviously changes the returns. Okay. What Rob is asking about are the reserve replacements. Reserve replacements are what the bank tells you need to set aside every month per unit for capital improvements. In other words, it's a way for the bank to scoop some money off the top so that you are forced to reinvest in protecting their collateral. All right? Pretty sweet deal for the bank. Now, typically what we see is about $250 per unit per year for reserve replacements. Now, these dollars can only be used for capital expenditures, not for operating expenditures. So you can only use them for certain things. And the bank, when you sign up with the bank, they will give you a list of what those items are. And you can only, you go out there and you spend the money on those items, you get the receipts, you send it to the bank, and the bank cuts you a check out of your own bank account and sends it back to you. So you get reimbursed for those capital improvements. You spend the money up front with the bank, you spend it again, you turn around and give the receipts to the bank, and they give it back to you. But it can only be used for capital expenditures. Now, capital expenditures are items that fall below the net operating income line. All right, they are not an operating expense, so they're not above the line. Now, here's where Rob is asking this particular question. When you look at a property package from a broker, they tend to put their pro forma and their actuals together, and they put the reserve replacement number above the line. Now, what happens when they do that is it reduces the net operating income. And when you reduce the net operating income, you reduce the value of the property. So why would a broker put the reserve replacements above the line when any CPA who is worth their salt knows that that expense is one that falls below the line and therefore changes the valuation of the property? Now, why do they do that? And I tell you something, no broker has ever given me a good explanation, but let me give you, Rob, the explanation that I have, all right? When the bank is calculating out the debt service coverage ratio, the DSCR and the DCR, The bank puts those reserve replacements above the line to calculate out the debt coverage ratio. Now, the reason why they do that is they want to make sure the property is generating enough cash to protect them. And if once they put that number above the line and the debt coverage ratio comes out fine, then the property can proceed forward. Now, when you are going, so that's fine. If that's the way they want to show that number when you're making an offer on the property, go ahead. Let them shoot themselves in the head. Go ahead. I don't care. But when you go to report this deal to your investors, when you go to try to raise private money and you're showing them your financials on this deal, you are going to put that reserve replacement number below the line. You want your deal to look as good as possible to your investors. All right? So it's almost like you're using two sets of books, but you're really not. You're reporting it the correct way. Let them report it the way they want, and then I will report it my way as well. All right? So those are the ways that you need to think about that answer. Rob, I think I totally gave you a beautiful textbook version definition of reserve replacements. Let me know how I did. Okay, Steve just said I answered the question already. All right. Okay, Harley asked a question. Can you give us some ideas on where to find people to raise capital? Okay, now Harley, let me ask you the question. Are you looking for people to put money into your deal, or are you looking to find people to raise capital for you? All right. Go ahead and answer my question on the box, and then I'm going to jump down to the next question, and then hopefully you will have answered that question. I will be able to give you the exact answer. Okay, now, Ronnie asks, probably they require 100% because the property is very risky or a C-class property. Okay, Ronnie, what do you mean by 100%? Who is requiring 100%? Okay, what happens if we get repair allowance at closing? Okay, all right. Now, listen, guys. Ronnie has just asked this one particular question. What happens if we get repair allowance at closing? Who gets that money? Okay. All right. I think we're mixing some terms up. I want everybody to follow me on this terminology. Okay. I have been talking about reserve replacements with Rob's question. Ronnie just asked me about repair allowances at closing. Those are two different things. And you hear me when you get to the point in the education, I start talking about what you should never put in the letter of intent. What you never put in the letter of intent is asking for a repair allowance. I know there's one particular guru out there who says you should do it every time, and my response is you should never do it in the letter of intent. And I give a full explanation as to why. But in this particular case, what Ronnie is saying is that if you asked for a repair allowance at the closing, who gets that money? I'll tell you something, Ronnie. Whenever I've gotten money back at closing to fix something, I got the money. The bank didn't get the money. So that money came into my company's pocket. It shouldn't go into your pocket personally unless you own the company 100%. If you are acting as a managing member for the LLC, that repair allowance is LLC money. All right? So make sure that you understand that and that you protect yourself. Because I'm telling you, if it shows it goes into your pocket, you're in trouble. You're in trouble, and you don't want to be in trouble. All right. So make sure you're very careful as to how you do that at closing. Make sure all of that money is accounted for. I'm telling you something, folks. I have an accountant just on the other side of my wall. He handles all of my properties. He's a CPA. All of my properties are perfect. That's why when I got sued by the SEC, they couldn't find anything wrong with my financials. Every dollar was accounted for. All right, and that's the way you need to run your businesses as well. So at the repair allowance at closing, if it is not disclosed to your investors that money comes back to you personally, then that money goes to the LLC, and the LLC should use that money to manage the property or to fix some of those problems. So that's the repair allowance. Now, what I was thinking that Ronnie might have been talking about was the reserve replacement. Now, here is a particular rub, and I talk about this in the section on assumptions. That reserve replacement gets accumulated every month. And if you own 100 units and you're putting $300 per unit per year into a reserve replacement, at the end of 30 years, end of a year, you get $30,000 in that reserve replacement account. And then the next year, you don't touch it. Next year, you do the same thing. Now you get $60,000. By the end of 3 years, you've got almost $100,000 in your reserve replacement, and you've never touched it. Anything goes wrong with the property, you pay it out of current cash flow. All right? Now you decide you want to sell that property to another investor. But because of your terms of your lending, of your mortgage, you can only have them assume it. So they are going to enter into an agreement with you where they're going to assume the mortgage. And guess what? They get approved. And the closing is going along swimmingly. And what happens at the closing table with that $100,000 bank account? At the closing table, the bank cuts you a check for $100,000 and says, thank you very much, it was nice doing business with you. And you walk away with that $100,000 that you never spent on the property in 3 years. The new investor, and this could be you, the new investor sits down at the closing table and the bank turns right away to them and say, we need $100,000. And you look at them and say, well, wait a minute. No, that was his reserve replacement. I'm going to build up my own. No. That $100,000 is money that we need on this property that's never been spent on this property. So we need you to replenish that bank account. Like, wait, I didn't account for that money when I was putting together my sources and uses. Well, you probably should have, because we're not going to let you do this deal unless you put another $100,000 in a bank account. Right away, that has just increased your capital needs of the deal. And you never even saw it coming. So how do you protect yourself against that? In the letter of intent, whenever you do an assumption, you always put a provision in there. And I believe a template, LOI template version for assumptions on the resources and archives section of the membership site has this wording in it. What you're going to say is that the seller either has to transfer that $100,000 to you at closing, or he's going to spend $100,000 on the property before closing. One or the other. But that money, that $100,000 is meant to be spent on the property. And you want it either down to zero or you want it. Because if you don't write that in the offer at the closing table, you are going to have to come up with that money. How do I know that? Don't ask. Just don't ask. All right, let me see. Ronnie, I think you just, okay, let me see. I got one of Ronnie's questions answered. Let's see. Put money into a blind pool for our deals. Can you give us some ideas on where to find people to raise capital, put money into a blind pool for our deals? Okay. Don't call it a blind pool. Blind pool is something that politicians use so that they can't be accused of, favoritism. They do it anyway. But okay, you want to do a pool for your deals. Best way to raise money. Where do you find these people? Well, obviously a crowdsource site is not a site for people looking to put money into your pool. Putting money into your pool, I think, is the best way to do it. But the problem with the pool is if you're a new investor in new and multifamily, you got a problem. Because if you've got this problem where you've got no experience, who's going to put money into your fund? All right. If you've got experience in investing, you've got another, you've been doing this for years on the single family side, you're going to use that knowledge base, and that's going to be what you transfer and use to sell your fund. But if you've got no experience, it's tough to raise money in a fund. So, the alternative is to do what I call a one-off, where you go out and do one deal. And, you go out there and you raise money on that particular deal, and people can look, touch, and feel that deal, and they know, okay, I'm buying that particular deal. And it's a lot easier to raise money as a new investor on a one-off scenario, okay? It's harder to do on a fund basis when you have no experience, because people are looking at you saying, well, what are you going to invest my money in? Well, we're going to invest it in these types of properties. Well, show me one of these properties. Well, we haven't found one yet, but put your money in this fund, and we'll go out there and find them for you. You see, it's a little bit harder to sell it that way. So where do you find these people? You find them the same places you do any other types of deals. You always have to be selling. You have to be selling yourself. You have to be selling your properties. You have to be selling yourself to brokers. You have to be selling yourself to investors. You're constantly selling yourself in this business. You hear me say it a million times. This is a sales business. It just is. Most people don't want to hear that, But 90% of this business is marketing. You're going to market yourself. You're going to market your deals. You're going to market your investment opportunities. So you want to make sure that everyone you talk to, you say, hey, listen, and this, write this line down, because I've used this line a lot, and it's a very productive line. And that is, whenever you speak to somebody, say, hey, listen, I'm buying apartments now. I'm buying apartment buildings, and I'm looking for people who are interested in investing in apartment buildings. Do you know anyone that I could speak to who might be interested in finding out more about apartments? And you say it that way, because what you've done is it's really kind of a passive-aggressive mode. You've allowed that person, you're not asking that person, hey, do you want to invest in my deal? You're saying to that person, hey, do you know anybody that I could talk to who might be interested in investing in apartments? So right away, you've deflected it for them. They don't feel obligated, like, oh, I got to say no to this guy. Now they're looking, you're asking them for help, and people like to help other people. So ask everyone you speak to, Harley, constantly say, hey, who do you know that might be interested in investing in multifamily property? I'd like to go talk to them. And that's how you do it. Harley, I know you're in the elite program. You're going to be getting the 6 private money tutorials. They're kind of like this particular group coaching call. They're very hands-on. I want you to know exactly what you have to do. I've raised millions of dollars on multifamily deals. So, that's the thing that, but there's a right way to do it and there's a wrong way to do it. I always want to teach you the right way to do it. I don't want to see anybody get into any trouble. So be very, very, make sure you seek the advice that we put in those private money tutorials, and and just don't start talking to people about, oh, I'm going to get you a 12% return, guaranteed. Oh, please, you might as well just put the cuffs on you now. All right, let's see. Ronnie, probably they require 100 because the property is very risky. Okay, I'm going to come back to that one. Put money into a blind pool. I took care of that one. All right, Rob, follow up. If you don't use the capital expenditures in your net operating income, won't your actual return be lower than you projected because it hasn't been accounted for? No, you are going to account. And especially in the cash flow analyzer software, it accounts for the capital expenditures. I mean, that reserve replacement is built into the calculations. It has to be. If you fail to put that in there, you are not disclosing how that property actually is running. All right, so those capital expenditures, the reserve replacements, there's a line item for them on the cash flow analyzer software. I believe it's in the input section where you need to put in there exactly what the annual reserve replacements are going to be, and that gets calculated under the CFA tab, the cash flow analysis, where you can see the cash on cash return that's being projected is being projected based upon the reserve replacements being correctly accounted for. So understand that the cash and cash return comes below the reserve replacement expenditures. It doesn't come above those. It doesn't come just at the NOI section. I mean, if NOI, then you got to pay the mortgage. Then you got to pay off any capital expenditures. Those types of things. And then whatever's left over is what your actual cash on cash return is going to be. So you've got to make sure that information is in there. You never want to disclose incorrect information to everybody. So, all right, Ronnie says thank you. So I think I answered her other question. I hope I did. And that's it, guys. That's it. Hopefully this was a good topic for you. Let me know what you think. If anybody has any other topics that they want to discuss in 2 weeks. Actually, you know what? Guess what? In 2 weeks, isn't that Thanksgiving? If that's the case, I'm going to have to change that time on the site. And so let's see what we're going to do about that. Let me just give you a couple of updates. Oh, see you in Charleston. Yes, Ronnie, I saw you signed up. Ronnie is going to be there in Charleston. I'd like to see all of you in Charleston. Remember, as Masterclass Elite members, you have that discounted price for the class. It's the due diligence seminar. If you're serious about this business, I highly recommend that you come to Charleston. I see that somebody just wrote on there that they've got their next week is Thanksgiving. Thank you, Vance. And Vance went to my due diligence seminar out in L.A. So he's a repeat offender. But I hope he obviously must have been pretty good if he's coming back for another session. But this is exactly how it works. Okay, great. I appreciate that, Steve. Steve's coming to Charleston. He says, I feel like this was very worth the cost. I'm excited. I'm telling you guys, it is intense. I love teaching that class because it is intense. It is not a rah-rah. It's not, the people that are in there are real investors. This is what they do. So, hey, I appreciate all the kind words. Yeah, thank you. This was a very powerful session. I have to run. Hey, yeah, we just had he's off the line right now, but we just had a world record holder in the in one of the swimming events. In world record. He set it in Germany. He's now a member of the master class, and so he just jumped up. He has to go work out right now. Yeah, fine. So do I. Yeah, I have to go take care of my 4 kids. Okay, so anyway, all right, everybody, hey, I appreciate you being on the call. It was a lot of fun, and I look forward to hopefully seeing you. Well, bear with me on Thanksgiving. I'll come up with a solution, but there will not be a call on Thanksgiving, and then I will hopefully get to see as many of you in Charleston as possible. Make sure you sign up for it because we are limited on space. I only keep it open for 25 people, and I'm speaking at the Charleston RIA on the Thursday before, and I've told them I'd save some seats for them there too. I do not like this to be a big class. I want everybody to have a lot of stuff that they can have full access to me, and that's the way I want to do this. Okay, and Rob just had one final question. Hey, Rob, I tell you what. Send me an email, ask me that question, and I'll get it answered for you. So, hey, thanks everybody. I will talk to you all soon, and thanks for coming. Bye bye.